The commemoration of 9/11 and pullout of U.S. troops from Afghanistan marked the passing of 20 difficult years. Historians will be debating the lessons to be drawn from this tumultuous time for decades to come. For investors, however, a crucial lesson to be drawn is clear. In the past 20 years, amid the unusual tumult and difficulties, broadly diversifying paid off, and quite convincingly at that. The Standard & Poor's 500 stock index averaged a 7.5% return annually in the 20 years ended December 31, 2020, and had a standard deviation, a measure of its risk, of 17.8%. In contrast, a broadly diversified portfolio comprised of 12 assets equally weighted delivered 91% of the return of stocks, but with only 69% of the risk. To be clear, the standard deviation of annual returns on a portfolio invested 100% in stocks was 17.8% and returned an average of 7.5% annually in this 20-year period. A portfolio with 12 equal weightings of different investments had a standard deviation of 12.3 and a return of 6.8%. That's the trade-off investors want. About 10% less return over this 20-year period, but about 30% reduction in volatility. Reducing volatility by 30% with only a 10% reduction in return is a more efficient portfolio. It's clear evidence that, even over this 20-year period filled with world-shaking events, a strategic approach of broad diversification worked. A one-asset portfolio, 100% invested in a risky asset, like stocks, average a strong 7.5% annual return. But you would have had to endure wild swings in the value of your portfolio that annually averaged 17.8%. Wild ups and downs are often not stomached easily, making investors more prone to sell at market bottoms and abandon a strategic investment plan. Meanwhile, a one-asset portfolio, 100% invested in ultra-low-risk 90-day Treasury bills, averaged a meager 1.4% annual return and a standard deviation of just 1.5% during this difficult two-decade period. A two-asset portfolio, combining different blends of stocks and T-bills, yielded the risk-return curve in red, with the least volatile investments being added first. Adding each of the 12 asset classes in equal amounts for the 20-year period created this very favorable risk-return curve. The combination of all 12 asset classes yielded the most efficient portfolio. Strategically investing in a broad set of assets worked even during one of the most difficult 20 years of the modern era.